Well, I think banks have lagged understandably because rates are low. If we're worried about deflation, it's tough to be overweight and expect a lot of earnings momentum from banks. But they are beneficiaries when economic momentum recovers. So I think banks are suffering from the same thing that's affecting all these reopening stocks, which is if the market cares about price momentum or earnings visibility, they're going to be buying the same mega cap stocks and growth, and that's 76% of the market. So you have about a quarter of the S&P sort of stuck in neutral or actually in reverse, and those are what we call the epicenter stocks. I mean, I think that's where the risk reward is, but the rotation, people just don't have a lot of confidence that this rotation should take place.
I get your point on the epicenter stocks, Tom, which is the medical advancements are coming fast and furiously, and there's so much resources being poured into them, and that'll improve consumer confidence as we get better treatments and testing and vaccines as we're going in that direction. But what about the economic backdrop? Another more than 800 million people still filing for unemployment claims, 800,000, excuse me, for unemployment claims last week. The fact that Congress doesn't look set to pass a stimulus anytime soon, and that other stimulus is wearing off. I mean, how does that affect some of the more cyclical names that you're gravitating toward?
Yeah, well, Sarah, that's a good point. I mean, the economy is still under depression. And I think consumers are still really nervous about the disease. And so that's affecting their willingness to reengage. But we're starting to see some positive things. I think JP Morgan requiring a lot of its senior staff back in the office, New York City opening for dining in September 30th. These are some signs of normalcy, and I think that's going to help consumer confidence. But with regard to markets, I think relative value has always been really important to understanding where equity should be. Bonds have behaved, as Michael was mentioning earlier. And if you look at corporate bonds, you're paying 50 times for an investment-grade bond. The same company, and it's an investment-grade epicenter stock, is trading at 15 times. So investors are putting a huge premium on the same bond of a company where they think the stock is dangerous. And I think that convergence in the past was always stocks follow what bonds do, which means stocks could really re-rate higher. So that's the reason we think there's a huge margin of safety in the epicenter stocks.
Tom Lee, just one final quick question. What do you think of gold from here?
I think we have some credible argument that you want to have some inflation protection because of the level of money printing that's out there. And if you look at the amount of wealth in America, there's $100 trillion of net worth. So Americans, I think, should have some exposure to gold as an inflation hedge. Of course, Bitcoin as well.